You don't want to miss this episode. We're going to talk beyond infinite banking. What other uses do we have for high cash value life insurance? We're going to share 5 key ones today. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. Christina, how you doing?
Hey, Darren, I am doing great today. Excited to talk about this topic. I don't think it gets enough love out there on the social media side. We hear so much about infinite banking, but there's just so much more to it.
Yeah, absolutely. So we're going to really dig into 5 key concepts or 5 key ways you can use the high cash value life insurance beyond infinite banking and but beyond just creating your own banking system. So let's dig in.
Well, before we get started, do want to remind everybody, if you're listening on your favorite podcast platform, please make sure that you subscribe and leave that 5-star review for us, please. And if you're listening or watching on YouTube, please make sure you like, subscribe, hit that bell button so you always know when new content is coming out. I promise you, you are not going to want to miss it. All right. So
now we can dig in.
Yes, now we can dig in. So I'm excited for this because whether you're a business owner, an investor, someone looking to build their wealth, like there is a place for high cash value life insurance for you. And infinite banking is a part of it, but I want to dig into these other strategies that we use it for too.
Yeah, 100%. So this is for business owners, for non-business owners, just
everyone,
regular people.
Yep.
So we'll use the business owner in the first example, and that's corporate-owned life insurance, corporate-owned high cash value life insurance. And this is one of my favorite as a business owner. If you are a business owner, you've got to educate yourself on this. Talk to one of our wealth coaches, watch some podcasts, whatever. You have all this cash. A lot of people have cash in their business, and what do they do with it? Well, you don't have like a TFSA in your business, but this really is like a TFSA on steroids inside your business. So you can earn money inside your business, pay that small business amount, right? 10, 12%. You're left with those really tax efficient dollars, and you can put those dollars directly into this high cash value life insurance. It's going to grow and compound completely tax free. You can use it in the short term if the business needs it. You can use it in the midterm if the business needs it. You can fund real estate purchases with it, business expansion, business acquisition. It's like an opportunity emergency fund just sitting there for the business. It's not going to attract tax. It's not going to affect your passive income. It's not going to affect any of those things. And then we talk about this, Christina, but I just want to take a second to talk about this capital dividend account. And if you're a business owner and you don't know what a capital dividend account is, you need to find out. A capital dividend account is money inside your corporation that can be paid out tax-free to shareholders. And that's pretty cool. Take money in your corp, pay it out tax-free. Well, this high cash value life insurance, when you eventually die, creates a massive capital dividend account. Let's say it's a couple $1 million that come in tax-free to the corporation. Life insurance is received tax-free, and usually all, or at least most of that, can flow out to the surviving shareholders completely tax-free. I don't think there's any more impactful vehicle financially for a business owner that is going to allow you to get that much money out of your company tax-free. And knowing that much money is going to come out of your corporation tax-free at your death gives you so many other planning opportunities, how you can spend your other money differently. It is just absolutely amazing the impact that is. And then the other thing I really like about high cash value life insurance for business owners is you can use it as your tax-free retirement account. So it's not like, life insurance, when you think of term insurance, well, great. The benefit, you need to die, which isn't great. But yes, it does protect your family. Well, you're buying this for yourself. You're buying this for your business in the early years, but in the later years, it's going to be for you because you can actually access tax-free loans that you don't ever have to repay in retirement. So picture as a business owner, you're using this for business purposes for the next 20 years. All of a sudden you're retired and you go, oh, wait, I don't need it for the business anymore. And now I can take a couple $100,000 a year tax-free to top up my income, not affect any of my government benefits, not affect anything else, no tax. I don't repay those loans until death. When the money flows to the company, death benefit flows out through the capital dividend account, loan gets paid off, and your family's still going to get a boatload of tax-free money. It is the most tax-efficient way for a business owner to store their wealth, to save their wealth, to grow their wealth, and retire.
Yeah, it truly is amazing. Like I tell people, corporate-owned life insurance is a tax strategy and a strategy all in itself. The cool thing is Infinite Banking uses the exact same product, right? So you don't have to choose one or the other. We can, with all of these strategies we're talking about today, they're all the same product that we use Infinite Banking for. So a strategy in itself, but that high cash value life insurance that we use. So the next one I want to talk about is using high cash value life insurance as an asset class. And this one's cool because it's all about diversifying your portfolio. So for a lot of individuals out there, you're going to have a portion of fixed income in your portfolio, right? We all hold on to that as the emergency and to be able to tap into. Fixed income traditionally doesn't give a high earning return, right? It's usually pretty low. What we can do is we can actually reallocate that fixed income into a life insurance policy. And this could be corporate or personal, but we reallocate that fixed income component of your portfolio into the life insurance policy, and it's going to really diversify your portfolio. Because now you're going to be earning between 4 to 6% tax-free on it, which is great, much better than what you can traditionally get, thinking about especially in a taxable account, right? So we're going to have that nice return. We're going to have access to it for whatever we need. So easily access it through those policy loans, no questions asked, unstructured. So easy access, very liquid. We're also going to be able to create a more efficient way to pass down that wealth, right? So a traditional fixed income GIC, you're passing that down to the next generation. You're getting taxed on that, right? It's going to go through the estate, probate, all of that stuff. Not this life insurance. We've made it completely tax-free. It's going to bypass probate, 100% tax-free onto your beneficiaries. So we've created a portion of your portfolio that is now going to benefit your estate planning while still having access to it. It's going to give you a better return overall long-term, and it's going to do everything that fixed income would do plus more by diversifying that portfolio. It's also uncorrelated to the stock market, right? When we see, if we go back to 2008, dividends paying were around 7.9%, right? Like that's not correlated to the stock market. So it's a great place to park a portion of your money in your overall portfolio. Why wouldn't we want to utilize it? And if we go back to that corporate business owner side of things, even better, because like we talked about, this grows tax-free like a TFSA, also doesn't create passive income, which is huge for business owners. When you go to invest in your corporation, you have to be very cautious of the passive income that you're building. You build too much, it's going to impact your small business tax deduction, right? We're not going to have that problem with this, right? So I definitely, especially corporate business owners, you definitely want to be using a portion for your fixed income. Most of us with retained earnings, we don't want to take the risk anyways, right? So why wouldn't we get the 5 to 6% tax-free using that strategy of reallocating fixed income, retained earnings, things like that in our portfolio?
Yeah, I love it. Like cash value life insurance as an asset just makes so much sense. I mean, it's almost doubling your fixed income returns if it's going to earn the same amount and grow tax-free. Plus it has the death benefit. Plus it's an and asset. Plus you can leverage it and all that. And really, if you think of it, it's not really costing you money or out-of-pocket money. If you have a portfolio now and you have, 20% or 30% in fixed income, we're just reallocating that. And it's not an expense at all because it's literally an asset. It's an asset on your balance sheet if you're a business owner. It's on your personal balance sheet if you're an individual. So it's just an asset reallocation, and it's a really powerful strategy, one of the best ones out there. Then if we get to retirement planning, again, this can be for an individual, can be for a business owner too, but if we stick to the individual, well, you have to save money somewhere for retirement, right? All Canadians need to save money for retirement. And this is a really effective place to put a portion of your money. You're going to put the money in the cash value life insurance. It's going to grow tax-free for the rest of your life. You're going to be able to get tax-free loans for opportunities and emergencies. When you take those loans, it won't affect your growth, right? Traditional investments, you see a great opportunity. What do? You sell your investments and you stop the compounding and have to restart. So it doesn't affect your compound growth when you take those loans. Has a massive death benefit at retirement. Okay, death benefit, what's that going to do? It's going to allow you to spend your other money differently, right? If you know you have a couple $1 million coming due at retirement, maybe you can spend your other assets down. Maybe you can get a loan against your rental properties. Maybe you can do that. And then just purely from an income standpoint, you can start taking tax-free loans in retirement that you never pay back until death when the death benefit pays it off. And that money is going to be completely tax-free. You're not going to get a tax slip. It's not going to show up on any CRA radars. If you have government benefit issues, like a lot of people, the old age security clawback, if you make too much in retirement, it's not going to affect that. Some government benefits like long-term care facilities are income tested. This is not going to show up as your income. protected from creditors. It is an amazing vehicle for retirement planning with all kinds of bells and whistles that go along. So another great point of not having to die to benefit from it. So people, you got to get out of your head that you got to die to benefit from life insurance. This type of life insurance that we do, you benefit immensely in your lifetime.
Yeah, and I think the retirement planning is so important because there's so many out there that are worried about the accumulating and not so much the spending in retirement. And adding this to your plan gives you a tax efficient way to be able to spend your money in retirement as well, which is just as important as accumulating, right? Like it's a very important piece. So another really good, a good retirement plan that you want to look into for sure.
Yeah, I think we did a podcast on the volatility buffer where it says, if you have a stock market portfolio and you have this uncorrelated asset, cash value life insurance, what you can actually spend a year could be twice as much because of this uncorrelated asset. So you can check that podcast out as well.
Absolutely. So the next one I'm going to bring up is it's life insurance. So estate planning should be on the list, right? But this high cash value life insurance isn't just estate planning. It's not just there to fund a tax liability. And that's what a lot of people think life insurance, you buy this policy, you pay the premium. When you die, death benefit pays out, and away you go. It's going to fund the tax liability. Especially if you have large estates, you're going to need something to be able to do that so that your family, your heirs don't have to liquidate your assets, right? You worked hard for those assets. You don't want them to have to liquidate them. Using this specific type of life insurance not only funds the tax liability, but it also reduces the tax liability, right? There's a lot of accounts out there that on estate, when we do the math, we've talked about RSPs on here a lot. When you die, your RSP is fully taxable, right? You're about half or less going to your heirs. So it's very important that you pick the right products to be able to save into from an estate planning perspective as well. And with these products, when they pay out, they're going to be a large asset in your estate, in your portfolio, but they're going to pay out completely tax-free, right? We're going to bypass probate, 100% tax-free, the most tax efficient way to pass down wealth to the next generation. On the other hand, too, though, a lot of people will say, well, that's great, Christina, but I want to have access to my money. I don't want to tie my cash up in premiums. Well, we don't have that here, right? We have full access to your money at all times. You use it for your retirement, like we talked about. You use it for whatever you want. You're investing, growing out the rest of your portfolio, but you're going to have access to it while still providing that death benefit for the estate, which is huge, right? And when we talk about corporate business owners, when it comes to estate planning with this stuff, like the sky's the limit. There's a lot of strategies that we can use high cash value life insurance for in combination with estate freezes. We use it in combination with trusts, things like that can really reduce your tax liabilities and fund them at the same time. So from an estate planning perspective, there is no better product out there to be able to pass down that wealth to the next generation. No.
And people, one of the comments sometimes we hear is, well, no one left me anything, and I don't want to leave my kids all kinds of money. And it's like, well, when we sit down and we do the math with them, and it's like, okay, so your choice is to die with money in the bank account that's worth X, or we could make it worth 3, 4, 5X. Number one. Number two, the way often it's structured is half of your money or quarter or to half of your money or more is going to go to CRA, and then your family's going to split up the rest. What if we could take CRA portion and shrink that down considerably and use that to give the kids, the family, the charities, some causes you believe in much higher? Wouldn't that make sense? So again,
Well, that's a great point, Darren, on the charitable side of things. Like you can either give it to CRA or we can give it to the charity of your choice, and we can have your name up on a building and we can create a legacy for it. It doesn't have to go to the kids, right? We can decide where it wants to go. But I am sure we all agree that we'd much rather it go to a cause that we want than to CRA, right? So why wouldn't we plan for that?
Yeah. Okay. So speaking of kids, the next one I want to talk about is education funding for kids. So most people have heard of RESPs, Registered Education Savings Plan. Now, one of my problems with an RESP, one of my several problems, I guess, is it's a government program. And I'm not a big fan of government programs. There's rules, regulations, there's changes, and really you have to use it for education. So you think today some of the trends of kids so many more people going to trade school where they're maybe go a year or two, or people starting businesses, or they're, we got some YouTube young clients that are making all kinds of money on YouTube. There's so many different things that your kid can do. Well, RESP is so limited versus if you start a kids policy, you can fund it. It's going to grow tax-free. And then when the kids get to university, you can take loans out to pay for the university. What if they don't go to university? Well, maybe you can use that to fund a business for them. Or maybe they want to get into real estate, rental real estate to fund that. There's so many, literally the possibilities are infinite, the reason we call it infinite, but there's so many more options with the cash value life insurance. And what I love about it is, full disclosure, when my son was 2 and my daughter was still in my wife's belly, I had a really big year financially. And I was, new dad, and I'm all proud, going to be a dad the second time. And I took this huge lump sum and I started an RESP for my children because I was a good dad. That money's been in prison ever since. It's literally been sitting there. And now my daughter's in university on almost full scholarship, and that money's been in prison. If that money had have been in a cash value life insurance policy on my kids, maybe I could have bought 2 or 3 rental properties along the way. Maybe I could have leveraged it, bought a property, used cash flow, refinancing, pay that back. Or maybe I could have bought them a building. There's so many other options I would have had. And then I could have said, well, maybe we'll use it for your first home, your first business, your first rental property. And the tax implications of a kids policy in Canada are so amazing because you buy the policy on your kids, you fund it, you control it, you own it. If your kids don't go in the direction you want, you can cash it out, you can use it for your lifetime, you can keep it till the day you die. But if you transfer it to your kids, which would be the plan, when you transfer it to your kids, all that compound growth you've had for the last 10 or 20 years transfers to the kids with no tax implications. And I look at it saying, if you think of the exponential growth curve, what if you could give your kids a 20 or 25-year head start on that compound growth curve? So now when they're 25 or 27, when you give them the policy, they can start saving in that same policy, but they've got such a massive advantage versus everyone else out there. They've already had 20 or 25 years of compounding. So it's an absolutely incredible vehicle to fund future expenses for your children, whether that be education, a new business, a new house, a new car. And the last part is, I don't have any grandkids. I'm in no hurry. Look forward to them someday. But one of the cool things about a kids policy from a legacy planning standpoint is it's actually helping 3 different generations. So I own the policies on my kids. My wife and I can benefit from that now. We can use the money to do a real estate deal, do a business deal, buy Bitcoin, whatever we want to use with it. We'll pay that back before we give it to the children. So it helps us. It helps my kids because now they're going to be so far ahead of everyone else out there because they're going to have this cash value that they can leverage for their first home, business, etc. And because the kid is the actual life insured, the death benefit's on my kids. So hopefully 100 years down the road, when my kids pass away, well, these future grandkids that don't even exist yet, they're going to benefit from the death benefit. So you've helped 3 generations with this. So much better than an RESP, so many more options, no restrictions, and not government regulated.
Yeah, it's huge. And you start throwing in trusts and using holding companies, things like that to build out a legacy and long-term planning for your family. It can go past the 3rd generation, right? Like we can make this go on forever. You can build out an actual legacy with these products, which is pretty cool. It's pretty unique. So I think, we love infinite banking, don't get us wrong, but I think we've kind of gone through a few different strategies that these high cash value life insurance policies can utilize as well, right? So they're not just infinite banking. Like we love it, don't get me wrong, but we can use them for so many other things as well. And the cool part is you can still do infinite banking. So we're not saying that's gone. We're just saying, utilize these other strategies as well as that infinite banking. You've got a very, very powerful tool when you have high cash value life insurance in your portfolio.
So you're saying look beyond infinite banking.
Well, beyond infinite banking. Yes. Yeah.
Yeah. Again, just such a powerful tool, and it's becoming more and more powerful as taxes are going up and other tax benefits are being taken away. Totally instrumental. So if you're interested in one of these 5 areas of to use cash value life insurance, reach out to Control and Compound. We get a wealth coach.
This is what we do. This is what we specialize in.
This is it. We are experts at this in Canada. So if you're a Canadian and you're looking for more information, you want more education, reach out to us at Control and Compound. Thanks for watching. Thanks for listening. Have a great day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.